Hello everyone and welcome to our exciting lecture series on financial accounting or principle of accounting, and I'm your instructor Jamal. Hi there. So today we're starting chapter 5, which is short-term investments and receivables. So in our previous lecture we have already finished how we deal with the cash, right? And among our balance sheet, our asset sides, this is cash, and the next one is cash and cash equivalents. We already finished, and now today we'll talk about the short-term investments and account receivable. So our first learning objective is account for short-term investments. So let's talk about that. So why company invest in other companies? Short-term investments, which means company have excess cash, and rather that cash just put into the company vaults or company bank account, it won't give you any benefit. So if company sees an opportunity to invest for short term, then it invests either in some kind of stocks, bonds, right? So what are the reasons to invest in other companies? First of all, excess cash, right? Which is very obvious. And the second one is for strategic reasons such as obtaining ability to influence another company. Now that is really important. It can be used for influence or it can be used as manipulation as well. So influence means, for example, a company purchases shares to its supplier company. So by doing that, one company can influence the decisions to its supplier company. Let me just write it down. So by purchasing the shares or stocks of the supplier company, company can maintain or lower down its raw material prices or can negotiate better in future for the raw material prices, right? Or in other cases, company can influence the supplier company for acquisition, right? So if you control 51% of shares, you can make a decision. So you are in that position to make a decision to liquidate the company, or sale of the company, or change the board of directors, and etc. Right? So to be classified as a current assets, investments must meet both following criteria. Number one, it must be liquid. What what do we mean? What do we mean by liquidity? Liquidity means easily convertible to cash. That's why we call that short-term investments, right? So that if we want to sell them, we can sell them in very short-term period of time. And then the second one is investor must intend to either convert to cash within 1 year or current operating cycle, or use to pay current liabilities. For example, we already know that it's short-term investment, so it's less than 1 year or 1 year. So, but what about this one? For example, if the company want to pay its current liabilities, want to pay its supplier, for example, 10,000, and right now company has 9,500, and company has to pay to account payable after 3 months. Right? But right now company has 9,500, so company can invest this 9,500, 95 sorry 9 yeah 9,500, and after 3 months company get 10,000, and company then pay to its account payable, right? So this is a normal and very shrewd way to invest in short-term investments, right? If this not happen, then the investment is classified as long-term investment, right? You tend to keep that asset for more than 1 year, right? Plus, it is not easily convertible into cash because this is for more than 1 year, right? So, categories of investments in the securities: number one is trading, number two is available for sale, number three is held to maturity. So, let's talk about trading. Trading, so both securities can be, for example, debt and equity. In debt there are bonds, notes payable, bonds payable, right? Or the other name is called debentures, right? Debentures. And stocks. So trading securities, they are expected to be sold within near term through active trading, plus generate income or loss on a day-to-day basis through changing in their market prices. So it's like that company has excess cash for 3 to 4 days, right? Company sees an opportunity in stock market, and company saw that one share is, it would be expected to increase. Company invests in that share, and after 3 days, company sells that stock and take out the cash from the stock market. Similarly, company see that a bond price is right now, bond is selling at a lower price, so should buy that bond, and after 3 to 4 days, or after a week, or after 2 weeks, company can sell that when the price of the bond increases, right? Company can sell that and increase its revenue as well. Next one is called the availability for sales. Availability for sales, they are held with intent of selling sometime in future. 3 months, 1 month, 4 months, 6 months, right? So not classified as either trading or either held to maturity, right? What do we mean by held to maturity? We will look at when we talk about held to maturity. But available for sale securities, short-term investments are those, like its name suggests, they are available for sale, but right now you keep it with the intention that in future it will give me some return. And the last one is held to maturity. So these are bonds, notes, or other instruments which have some maturities. So did you notice something? That it include only debt securities, right? In case of trading, we have stock plus bond, or equity plus debt securities. Here we have the same stock, sorry, stock plus bonds, but here we have only bonds, which is a debt securities. So the definition of bond is that you purchase a company debt for a certain period of time with specified interest rate. For example, 10-year for 10% interest, right? So held to maturity, it means you are buying that security which has some maturity. So why not stock? Because stock has no predefined maturity. Why is that? Because the company shares, you cannot say that, because there is a going concern that the owners can die but company don't die, right? So the shares can be transferable. So shares, they don't have the maturity. If you buy a share, it is not written on this share that it will be, after 10 years or after 100 years you will receive your money back. No. The Nestle company is more than 150 years old. There are many other companies that are, even for Coca-Cola companies for more than 100 years old. So that's why the stocks, they don't have any maturity value. So that's why we call this held to maturity securities as debt securities. So in 100% held to maturity securities are, we invest in that category in debt securities. And then investors has intent and ability to hold until they mature. You buy that bond, you keep it for 10 years and you interest 10% on your investment, right? Let's move further. So these are the categories of investments. We just discussed about that, and we will also cover into some other chapters as well. So just pause the video, try to look at this one. We already discussed about these. Okay.